Welcome to the packed weekend video, which is called More Tariffs. Following Canada, we got 30% on EU as of August 1st versus risk taking, not just equities. I will be covering, of course, yields, US dollar and real assets, so this will be fast and tight. Starting as almost always with yields, here we go, where I had called them midweek to be tired to keep rising. They took a breather, and now on Friday, against no news to speak of, well, apart from tariffs moving towards the front seat once again, just as in March, April, we are seeing them starting to rise. What? Guess what that would do with the US dollar. And now it's time to give proper intonation to the caption that I have prepared in the upcoming free article. We are having the big spending bill just in. Treasury supply will start growing. What does increasing supply versus however you want to describe worldwide interest in buying US debt instruments, what that would do to US yields, and when they rise, what would that do to the US dollar and risk taking in general? What would that do to equity risk premium and the competition that a risk-free rate of return presented by treasuries is giving to equities? That is one consideration. So we just may not be seeing, just might not be seeing US dollar go below 96.50, 95, or whichever target below this level you could be having viewed correctly, but still out of the technical reasoning, following technical chart reasoning. Now it's time for macro factors to start overriding that projection, because for now US dollar is quite tame, but once again watch yields, what it's going to be doing, and we are already seeing inflows into US dollar if you compare that against the Japanese yen. How many months have you not heard me talk about yen carry trade or Japanese government bond yields? And what have they done since? I've been on an on and off basis whenever it made sense, because you know my style, I don't inundate you with trivialities. I select rather what's meaningful and make it very short and very fast, because the purpose is not to dazzle you with intelligence and experience, but to give you actionable insights as to which way the market is just looking at that moment. So what are we seeing when it comes to Japanese government bond yields? They are rising on an uptrend because the Bank of Japan had been stepping away from active interventions in the Japanese government bond market. What does that do to yields worldwide? Of course, that puts a pressure on yields to rise, and lo and behold, now you are starting to see US dollar appreciate versus the Japanese yen. It's not that visible when it comes to comparison against the euro or the Swiss franc, so take it with more than a pinch of salt. Take it as a first swallow, rather, if I were to choose the proper idiom. Here we go with the weekly chart of S&P 500. Market breadth is deteriorating, and Friday we have been set up very nicely throughout the session, following good unemployment claims that I have been covering in earlier videos, recording them for you daily, striving to make them really short and actionable, so make sure to review them in case you want to be kept in the picture on a very fast and concise basis. So we are seeing deterioration in market breadth on a weekly basis because what tipped the scales? The power hour on Friday, and that's the most important power hour out of those 5 power hours that are presented to us every regular week. And we had seen selling across the board, across the various sectors, so that's not really encouraging, even though the longer term metrics of such as McClellan Summation Index and other which point to continuing accumulation in equities are still positive, but seeing Friday as a weekday following such a long string might be more than just a daily oddity. And once again I'm bringing the fact that we are now getting 30% tariffs against the EU announcement, and there is still much waiting what's going on to happen versus China, and we saw already how the allies of South Korea and Japan have reacted to their own presence. When it comes to sectoral perspectives, this is Friday's view. It might not look that bad, so this perspective is glass half full versus half empty. However, as I say, going into the close on such a cautious note is a cause of concern, and 5-day perspective, where it's just energy, utilities, pulling forward, and communications down, financials which had been down thanks to those yield games, yield rate cut expectations, and it was only Thursday when the call for fast lowering of rates came. That's another warning sign, and given that this is on a 5-day basis, I lend it more importance. So and a few promised words as regards real assets. Silver, great stellar performer, has called on for not just this week, but for the weeks prior, to consolidate the high ground, and we see that gold did not. That's what I have been talking premium with clients roughly 2 weeks ago, that gold is not meaningfully retreating. This is actually a very bullish sign that while silver is surging, gold is not going the other way very visibly. And when it comes to oil, following the Mideast ceasefire, I told you, as the situation was stabilizing midweek following that Monday's price announcement, that oil is embarking on an upswing, and we see that with its own ups and downs, it had appreciated meaningfully, which is something that trading signals clients have been enjoying throughout all this period. So let me wish you a great weekend. My join page, take daily analytics together with intraday channels for 100% coverage of what I do, including one-on-one.